Now the topic before us is whether central bank intervenes in currency appreciation. Now the answer is generally the central bank do not intervene. Generally, the central bank is oftenly concerned with currency depreciation, that the currency of that country should not depreciate. However, if there is excessive currency depreciation, excessive currency appreciation, the central bank intervenes if there is excessive currency appreciation. Then why do they intervene in case of excessive currency appreciation? To protect their exporters, because to protect exporters, because when the currency of a country appreciates, the exporting goods become expensive for the foreign buyers. So the exports of that country are adversely affected, and it also results into the job losses of the sectors involved in exports. So to protect exporters, central bank do intervene in case of excessive appreciation. They also intervene to maintain competitiveness, export competitiveness in the global market. To remain competitive in the export market, they intervene. Now the question is, how do they intervene? They intervene by selling domestic currency. When the currency has excessively appreciated, the central bank of that country sells the domestic currency, and the supply of domestic currency increases in the market, and so the value of that currency reduces. Excessive depreciation is offset. The central bank may also purchase foreign exchange reserves. So when the central bank purchases the foreign exchange reserves or foreign exchanges, foreign currency is purchased by the central bank, it reduces the availability of foreign currency in the market, and it indirectly reduces the value of domestic currency, because the foreign currency becomes more valuable. The foreign currency is being purchased by the central bank, foreign currency becomes more valuable, and it indirectly affects the value of the domestic currency. It is not that intervention by the central bank is easy, because the foreign exchange market is very vast, and large scale intervention by the central bank may be very costly, and the central bank may not be always successful, because its forex market is very vast and complex. Further, if there is large scale intervention by the central bank in the forex market, then it may give signal to the market that the central bank is losing confidence in its domestic currency. If the central bank is purchasing currency, its own currency, in large bulk, then it may send signal to the others that it is, if the central bank is purchasing foreign currency, then the investor from the other countries may feel that the central bank is losing confidence in its own currency, and it may adversely affect the value of the domestic currency. Overall, the central bank has many tools to manage the currency appreciation, It is a very delicate act and it has its own challenges. Now, the topic before us is what makes a currency appreciate. There are many reasons for the appreciation of the currency of a country. First is high GDP growth. When a country consistently shows high GDP growth, economic performance of the country is good for the last many years. So the investors from all over the world get attracted towards that country. So the demand of the currency of that country increases, which results into the appreciation of the currency of that country. Next is higher interest rates. It may be possible that in any particular country, the yields of financial assets like bonds is higher in comparison to other countries. So the investors from all over the world would like to make investment in the financial assets of those countries, those that particular country, which increases the demand for the currency of that country, and due to this, there is appreciation in the value of currency of that country. Next is trade surplus. Trade surplus means exports are more in comparison to imports. When the exports are more, it means that the foreigners have to pay more than to get from that country. So to pay for the exports, the foreigners will have to buy the domestic currency. It increases the demand for domestic currency and ultimately results into the appreciation of domestic currency of the that particular country from where the exports are being made. Next is if there is political stability in any particular country and the economic performance of that country is good, then the investors from all over the world would like to make investment in that country. So it increases the demand for the currency of that country. Further, if the stock market in a particular country is undervalued, if the investors think so, then they would like to make investment in the share market of that country and it increases the demand for the currency of that country and it results into the appreciation of the currency of that country. Next is speculative activity. If the speculators believe that the currency of any particular country is likely to increase, if they think so, then they will naturally buy that currency in bulk. It will increase the demand and it will result into the appreciation of the currency. All these factors result into the appreciation of the currency. However, how much currency appreciates, it depends on the circumstances of each economy differently. So these factors affect any economy in a different way. We also like to mention that there is real life example of currency appreciation in the case of Australia. During early 2010s, 2000s, during the early 2000s, Australia witnessed currency appreciation against US dollar because there was high GDP growth, booming was there in mining sector, and there were robust exports of coal and iron ore. And further, the political environment of that country was stable. So all these factors in Australia in early 2000s helped in the appreciation of the currency of Australia. Now the topic before us is understanding currency erosion, devaluation versus depreciation. First difference we will understand on the point of definition. In case of devaluation, it is the deliberate or official reduction in the value of a currency relative to other currencies by the government or central bank. What it means? We are living in India and approximately 83 Indian rupee are equal to 1 US dollar. If the government or the central bank of India decides to reduce the value of the Indian currency, then it is devaluation. Suppose it decides that from now onwards 90 Indian rupee will be equal to 1 US dollar. It is devaluation. This decrease in the value of Indian rupee vis-a-vis other foreign currencies by the government order or by the order of the central bank of the country is devaluation of the currency. Here, external forces such as demand and supply, etc., are not the reason for the reduction in the value of the currency. The value of a domestic currency has decreased only by government order. This is devaluation. Official order is there to reduce the value of a currency. On the other hand, if the value of a currency depreciates in comparison to other currencies by the forces of demand and supply, then it is depreciation of the currency, where the market forces of demand and supply come into picture and the value of a currency decreases, it is depreciation. Exchange rate system. Devaluation occurs under a fixed exchange rate system. Fixed exchange rate system means where exchange rates are predetermined and the government intervenes to maintain that rate. We take the example, suppose if the government of a country decides, suppose a European Union, we are taking the example simply, that if European Union decides that 1 euro should be equal to 1 US dollar and it should remain somewhat as it is, and to maintain that balance it will be taking steps that the one value of 1 euro remains equal to 1 US dollars. So this is the fixed exchange rate system. So typically occurs, and this devaluation occurs under a fixed exchange rate system where the exchange rates are predetermined and the government intervenes to maintain that rate. Suppose if the value of euro increases and the European Union is following fixed exchange rate system, suppose here 0.9 euro becomes equal to 1 US dollar, the government of the country may reduce the value of its currency to ensure that it again becomes equal to 1 euro is equal to 1 US dollar. Then depreciation. Depreciation of the currency occurs under a floating exchange rate system. When the demand of the currency falls, when the demand of anything in the market decreases, what happens? The price of that goods decreases. In the same way, in the foreign exchange market, when the demand of a currency decreases, the price of that currency also decreases. So this is the depreciation, and it occurs under a floating exchange rate system. Now, what is the cause of devaluation? The cause of devaluation may be government policy decision. The government of the country may have decided that it wants to make exports cheaper and imports more expensive, so that it may improve the trade balance. On the other hand, depreciation of the currency may be caused by the change in supply and demand of the currency, domestic currency. There may be negative outlook, economic outlook of the country, economic performance of the country is not good. There is political instability in the country, and the speculative investors also believe that the value of the currency is likely to depreciate in the near future, so they will offload their domestic currency, so it will result into the depreciation of the currency. Speed. Devaluation is a one-time exercise. The government may have decided that it wants to reduce 10% reduction in the value of the currency. It is a one-time decision. The government of the country may decide any percentage, 1%, 2%, 3%. And this is a one-time devaluation of the currency, one-time reduction in the value of the currency. This action has immediate impact. If suppose at present 80 Indian rupee are equal to 1 US dollar, and if the government of India decides that it wants to devalue its currency by 10%, then what will happen? Immediately 88 Indian rupee will become equal to 1 US dollar. Impact is immediate on the exchange rate. However, in the case of currency depreciation, the depreciation of the currency can be gradual or rapid depending on the underlying market forces. The impact of depreciation might not be as dramatic and immediate as the government driven devaluation. It means that in the case of devaluation, there was immediate reduction in the value of the currency. That is, if the government decides at this point, there will be immediate reduction in the value of the currency. But in the case of depreciation, the value of the currency depreciates slowly and slowly, or it may be rapid, but not as fast as happens in the case of devaluation of the currency, because in case of devaluation, it is by government order and it has immediate impact in the foreign exchange market. Now, appreciation of value. In the case of devaluation, it is possible for the government to raise the value of the currency after it has been devalued. It means that today the government decided to devalue its currency. Now, after some months, it decides to raise the value of its currency. It may do so. It may raise the value of the currency, but it is a very complex and challenging process to raise the value of the currency once it has been devalued. That is, if today 80 Indian rupee are equal to 1 US dollar and there was 10% reduction and 88 Indian rupee was equal to 1 US dollars. But after some months, the government decides to reinstate that original position. It wants to increase the value to 80 Indian rupee equal to 1 US dollar. It may not be as simple. The value of it is not possible to increase the value of the currency in one shot. The devalue is simple. To increase the value is not as simple. It is a challenging process. In the case of depreciation, once the currency has depreciated, it is possible that it may appreciate, but this is not a guarantee. If there is political instability in the country, the foreigners are not interested to make investment in the country, then what will happen? There will be no demand of the domestic currency in the foreign exchange market. However, if the demand of the currency increases, the outlook of the country improves, economic performance improves, the investors think that it will be worthwhile to make investment in the country, the demand of the domestic currency will increase and the value of the domestic currency will increase. Next is control. In the case of devaluation, government has direct control over the timing. It may decide that it will devalue its currency tomorrow or next week or on a particular date. The government decides what is the timing of devaluation and what is the extent of devaluation, whether it wants 1% reduction, 2%, 3%. The government decides timing and percentage of extent of reduction in the value of the currency. Government decides. But in the case of depreciation, it is the demand and supply in the foreign exchange market which decides the depreciation. For a larger market forces mostly dictate the pace and extent of depreciation. That is, the demand and supply mostly decides what will be the depreciation, whether it will be fast, gradual, or what will be the extent of reduction in the value of the currency. With the government having limited direct intervention, that is, in case of depreciation of currency, the government has very little intervention, direct intervention. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.